Welcome back, dear traders. On the final day of the week, traders will find a missing piece of the puzzle in the disinflation picture. Today, the economic calendar is full of data to shed light on the strongest sector, the US labor market. The employment data is not only a missing piece, but also a market catalyst. Earlier, the largest Silicon Valley companies spoiled market sentiment with the tepid corporate reports. Yesterday, Wall Street closed with notable gains. Investors were encouraged to find out dovish signals in a Powell speech. Meta also improved market sentiment. Not all benchmark indexes were lucky yesterday. The Dow Jones was wound down by a decline in the healthcare stocks and closed 0.11% down. The Nasdaq again logged the strongest performance and printed a gain of 3.25%. The S&P 500 climbed by 1.47% to close at 4,179 points. The major stock indexes were subdued in the New York pre-market. They shed early gains. The S&P 500 is expected to trade in the corridor between 4,070 and 4,140 points. Yesterday, both the Nasdaq and the S&P 500 closed with a rally and a jump to the highest level in 5 months. Investors were digesting the Fed's policy decision made on Wednesday and Powell's comments. He acknowledged the progress in the fight against inflation. The companies with a mega capitalization, such as Apple, Amazon, and Alphabet, advanced considerably by 3.7% and 7%. The telecom sector surged by 6.7%, the biggest intraday growth for almost 3 years. Meta shares, with its 22.3% growth, mainly propelled the rally. And this year, the company announced a strict control over spending and a $40 billion stock buyback. The energy sector, one of the most successful last year, dropped by 2.5%, and the healthcare sector slipped by 0.7%. United Health shares tumbled by 5.3% after the US government proposed Medicare Advantage reimbursement rates below analysts' estimates. This also affected the Dow Jones. Merck shares fell by 3.3% as the drug manufacturer provided a revenue forecast for 2023 lower than Wall Street's consensus. Interestingly, there is a glimmer of hope for investors. The 50-day moving average of the S&P 500 climbed above the 200-day moving average, and this formed a gold growth pattern. It's viewed as a technical bullish sign for the short term. Nevertheless, the late session yesterday challenged optimism and pushed the benchmark indexes down in the pre-market on Friday. Futures on the stock indexes lost ground after disappointing financial records by the companies with a mega capitalization, including Apple, Amazon, and Alphabet, and the high-tech giants lost 3.5% and 6% in the pre-market. Apple predicts another decline in sales revenue in the first quarter. Amazon warned that its operating profit could tumble to zero this quarter. Google's parent company, Amazon, fell short of expectations in terms of financial results for the fourth quarter. Besides, the employment data worsened market sentiment. The U.S. economy unexpectedly created 517,000 jobs in January. The actual reading is 3 times as big as the consensus. Analysts had projected a modest growth of 185,000, and the latest figure is the largest since July and is higher than an average increase of 101,000 per month in 2022. The most robust employment was recorded in the entertainment and the hospitality sector. The unemployment rate in the United States also dipped lower than expected. It slipped to 3.4% in January, lower than the consensus of a 3.6%. It's the lowest reading since May 1969. The strong non-farm payrolls were published after a sharp decrease in weekly jobless claims. It proves tense conditions in the labor market. The employment report is of a major importance to the stock market. Soft employment would enable the US Fed to raise interest rates by another 25 basis points. However, the red-hot reports wrecked this hope. Now, the Federal Reserve is unlikely to hit a pause button in the tightening cycle in the near future. The ultimate interest rates will be higher than expected. All in all, these small reports by high-tech giants and the gloomy forecast for this year are sure to push the stock indexes down. Tonight, investors will find the ISM non-manufacturing PMI, but its decent reading will not prevent sell-offs at the end of the week. The US dollar index is celebrating its triumph. It was hovering around 101.50 intraday. Instantly after the non-farm payrolls, it perked up, and the index gained 0.5% to trade at 102.3, and the intraday Canada is seen between 102.1 and 102.90. A modest rate hike and the dovish comments of the Fed chair weakened the US dollar because traders hoped that the tightening cycle could be halted soon. Nevertheless, the greenback rallied because the euro tumbled on Thursday when the ECB raised the refinancing rate by 50 basis points to 2.5%, but suggested that the cycle could be determined terminated after the next rate hike in March. The ECB looks less hawkish than the US Fed. Still, the US Central Bank has the key argument: the healthy labor market. Despite some signs of a cooling down, the fresh employment data for January turned to the picture upside down. If Powell had this argument by his press conference, no way he would have softened his stance. Such robust hiring could negative the risk-on mood investors gained earlier in the year. At the same time, the US dollar is unable to regain bullish momentum. The index is likely to hold between 102 points and 103.5 points, which is far away from the highs of September. The Canadian dollar is weakening amid the firm US dollar and the soft oil prices. Having grown by 0.23%, USD CAD traded at 1.3350 in the pre-market. The currency pair is expected to trade in the intraday Canada of 1.3370 and 1.3490. Brent crude is on a track to close the week with a 5% fall. WTI is likely to close 4% down. Brent futures edged up by 0.11% to trade at $81.26 a barrel, and WTI rose by 0.3%. Crude oil is facing muted trading until investors assess how promptly China will revive its energy demand and the fallout from the European Union embargo on Russian petroleum products and the price caps. On a Friday, EU leaders are striving to make a deal on ultimate price caps for Russian petroleum products. The Kremlin states that the embargo will play havoc with the global energy markets, so traders are in the wait-and-see mood. In this context, the loonie is facing a challenge to recover. After Bitcoin topped 24,000, traders rushed to fix profits. The token retreated to 23,500, and the crypto traded mainly flat intraday, ahead of the US non-farm payrolls. Ethereum, Solana, Ripple, and Litecoin gained from a 0.3 to 1.5%. After the recent rally, Bitcoin is ready to create the golden cross pattern for the seventh time in the last 10 years. The pattern serves as a buy signal, or at least indicates the bullish trend. If we suggest that Bitcoin does not fall sharply by more than 30%, the price could form the pattern in about a week. And the same pattern appeared in July 2015, October 2015, and April 2019. Traders generated a profit on Bitcoin of 130% and 120% and 25%. Make handsome profits with the InstaForex and have a nice weekend. See you next week.